We've all heard stories of investors who got lucky and made millions only to lose it just as quickly, making bad decisions trading. And every time the crypto market dips or the stock market dips, we find out just how much our own psychology betrays us when it comes to investing. According to JP Morgan, over a 20-year period from 1993 to 2014, the average investor made a return of just 2.3%. And over that same time period, the average inflation rate was 2.5%, meaning the average everyday investor over that period from 1993 to 2014 actually lost money investing. But how is that possible when the stock market goes up on average 10% annually? Because you're literally wired to lose money. You are your own worst enemy when it comes to investing, and it has to do with the way that psychology works. The average investor, because of the fear of missing out or the fear of losing money, is more likely to buy high and sell low. Warren Buffett, arguably the greatest investor of all time, once said, "Be greedy when others are fearful and fearful when others are greedy." In short, you need to behave in a way that most people don't if you want to be a successful investor. And it's actually this understanding about how most people, how the average person acts or behaves in the stock market or in the crypto markets that's going to help you win. Most people invest only once they hear about a stock or a crypto going up a lot in value. A friend might say, "I made $50,000 investing in blank crypto." So the average person responds, "Oh, since a lot of people are investing in this, crypto project, and a lot of people are making money investing in this crypto project, it must be a good one that's going to continue to go up." The average investor is looking out for investments that have gone up a lot in value, because in their minds, those must be the good ones. But of course, usually when something's gone up a ton in value, you're usually closer to the top of the market and end up buying high. And inversely, usually when an investment is tanking, it's going down a ton in value, the average investor doesn't want anything to do with it. They think because it's going down, it must be a bad investment that's going to continue to go down. When Bitcoin went from almost 20K down to 3K, people were saying that Bitcoin was dead, that all those people who invested in Bitcoin were idiots, that it was obviously a bad investment, and that you should stay away from Bitcoin. During that time period, if you would have told somebody that Bitcoin was actually a good investment that they should be buying a ton of, they would have likely ignored you, because if it was such a good investment, then why was it dropping in price? But obviously now in retrospect, buying Bitcoin at $3,000 would have been the most ideal time to have bought into Bitcoin. Bitcoin ended up going to, at its height, around $70,000, which would have been a 23x gain. And even at today's prices, you'd be sitting at a 10x gain, which would have turned every $10,000 you invested into $100,000. There's just something about us as people that we're wired to make emotionally charged, poor investment decisions. Most people avoid learning hard or technical things and wait to buy an asset or a crypto project until it's easy to access. They'll wait till it hits Coinbase and then they'll buy it, because they don't want to learn all the technical, crazy things they have to do to buy that asset early on. Most people don't take the time to do any research into projects and learn how they actually work. Most people don't take profits when they make crazy gains and instead get greedy. And most people go wild on one single investment that they think could go to the moon instead of diversifying their investments and spreading their money around. And most people have no investment plan or strategy, which is why when you invest like most people, you're bound to lose. So the question you're probably asking yourself is, if we're wired to lose, how can we make changes to the way we operate in our strategies so that we're wired to win? Number one, the first thing that most people don't understand is that even the best of the best never get it right 100% of the time. So as an investor, if you're expecting all of your investments to succeed, you're making a critical error. By the way, I'm about to go through a lot of info that comes from the book, The Psychology of Money by Morgan Housel. It's a really amazing book. I'm in the process of just finishing up reading it. I've loved it. It's one of my all-time favorite books now, and I highly recommend reading it if you want to go really in depth on this topic. Peter Lynch, a legendary investor, once said that if you're terrific in this business, you'll be right 6 times out of 10. Meaning if 6 out of every 10 investments you invest into succeed, you're among some of the best investors on the planet. Investment firm Correlation Ventures did a study of over 21,000 venture capital deals. And what they found is, of those deals, 65% of them lost money. 2.5% of those deals made 10x to 20x. 1% of those deals made more than a 20x return on their investment. And only 0.5% of those deals ended up making 50x or more of a return on their investment. The way that venture capitalists make money isn't by having every single deal that they make be a success, but by having a very small percentage of the deals they make be so radically successful that it offsets all the losses from the bad deals. They might have 10 investments where 6 of them outright fail, 2 of them do okay, 1 does good, and 1 does extraordinary. And it's that one extraordinary deal that covers all the losses from the 6 losing investments and accounts for most of the gains. And if you're thinking it's just venture capital, then you're wrong, because most public companies on the stock market operate in the exact same way. JP Morgan once published the returns of the Russell 3000 index, which is basically an index of a bunch of different various companies that have been around since around the 1980s. And over that time period, out of those companies, 40% of all of those companies lost over 70% of their value and never recovered. In fact, almost all of the index's returns came from just 7% of the companies in the index. And despite all of those companies failing and just a small percent of the companies succeeding, the index has grown by 73x since 1980, with just that small 7% of those companies driving the majority of those gains. The point is that the biggest gains you're gonna make often come from just a small percentage of your investment. You can't expect all of your investments to win, or even most of your investments to win. That's not gonna happen in the stock market, crypto, venture capital, you name it. So you have to adopt a strategy that accounts for the fact that you're gonna have a lot of investments that are gonna lose money. Billionaire investor George Soros once said, it's not about how much you're right, but about how much you make when you're right and about how much you lose when you're wrong. The second thing you need to change if you wanna wire yourself to win is that the superior strategy to win when it comes to investing isn't trying to time the market, but just continually investing despite market conditions. Timing the market is near impossible, but we're obsessed with all these strategies and all these people who claim that they are able to actually time the market and predict what's gonna happen next. The reality is though that in any given scenario, there's always gonna be people that are gonna say that the market's gonna keep going up, and there's always gonna be people that are gonna say the entire market's gonna crash. So no matter what ends up happening, there's always gonna be a group of people that ends up being right who claim that they predicted what ended up happening. We wanna believe in formulas, cycles, rhythms, and people who can predict the market. But even the best of us cannot predict what's gonna happen next. Famed investor John Templeton said, "The 4 most dangerous words in investing are, it's different this time." Michael Batnick followed it up with, "The 12 most dangerous words in investing are, the 4 most dangerous words in investing are, it's different this time." Because statistically, about 20% of the time, it really is different this time. Everything eventually changes, markets are unpredictable, and you have to accept that and develop a strategy around it. An example from the book, The Psychology of Money, really paints a clear picture on the winning strategy when it comes to investing. Consider if you invested $12 a year into the stock market from 1900 to 2019. The first investor, Sue, invests regardless of if the market's going up, down, sideways, is in a recession, isn't in a recession, or whatever. She just consistently invests $1 a month, $12 a year. The second investor, Jim, only invests when the market's not in a recession. He sells when the market is in a recession and instead saves his money in cash. So each month he's still taking that dollar and he's putting it into cash and saving it away. And then once the market comes out of the recession, he reinvests the money. The third investor, Tom, also tries not to invest during recessions, but he takes a few months before the recession scares him out, and he takes a few months once the recession's over before he gets back into the market. How much do you think each investor would make over time, and what strategy do you think would win out of the 3 different strategies? Tom, the last investor, ends up making $234,476. Jim, the second investor, ends up making $257,386. Sue, the very first investor who invested regardless of market conditions, ends up making $435,551. Sue wins by a long shot and shows that her strategy is the dominating strategy, and that's just to invest regardless of market condition. The third thing you need to learn if you want to wire yourself to win is that you have to be taking profits along the way and setting them aside. It feels counterintuitive to take money out of an investment that's rapidly going up. But I've had projects that have tripled in value. I didn't take out a dime, and then they ended up crashing back down to a lower low than I originally started with. It's crucial, especially on risky projects, to be taking profits. In crypto, for me, each time I double my money, I try to take out my initial capital, which that allows me to take my risk off the table and lets me sleep at night, regardless of what that crypto project ends up doing. But on top of just taking profits, you also need to be setting those gains aside in cash or in a stable asset. And of course, it feels horrible to have a bunch of cash just sitting there while all your investments are going up, and you're doing the math and you're calculating and you're thinking, well, geez, if I had this money invested, look how much money I could be making if I'd invested in this project or that project. But it feels a lot less horrible when the entire crypto market crashes to rock bottom prices, and you're sitting on this massive pile of cash, allowing you to get into your favorite projects at all-time low prices. Keeping some money in cash allows you room to maneuver when the market dips and gives you opportunity while everyone else is experiencing massive loss. As Morgan Housel says, the most important part of your plan is planning on your plan, not going according to plan. If this stuff was interesting to you at all and you want to go more in depth and you really want to educate yourself on how to be a better investor, I highly recommend reading the book The Psychology of Money by Morgan Housel. This isn't paid, sponsored, or promoted. I actually learned about this book in the comment section of one of my other videos where I did a video on some of my favorite books, and a lot of people recommended The Psychology of Money. I'd never read it, so I put it on my list as my next book to read. I ended up loving it. It's on my all-time favorite list of books. It's top 10 of the best books I've ever read. You will not regret reading this book if you're heavily into investing. And as always, none of this is investment advice. These are just ideas and topics that I'm learning as I'm on my own investment journey to try to make $1 million. If this video is helpful, make sure to hit that like button. If you have any questions or comments, let me know in the comment section down below. If you want to see more videos like this, make sure you hit that subscribe button, and you got to hit the little bell next to it if you want to actually be notified each time I release a video. If you don't hit the little bell, you won't ever be notified when I release a video, but you'll have to actually go to my channel, go to the subscriptions tab and find it, and then check out if I've made new videos. So that little bell just allows you to get a quick notification each time I upload a video. Thanks for watching, and I'll see you next week.